Hi there. Today we explain the UK lump sum allowance and the 268k tax-free pension limit. Understanding this rule is essential when planning pension withdrawals in 2026.
Hello there. Here at ProTax Accountant, we spend our days guiding UK business owners just like you through the, let's face it, pretty complex world of tax and finance. And today we are tackling a massive change that affects your retirement and your legacy, the new UK pension rules. Honestly, if you've spent years building your business and your pension pot, you cannot afford to miss this.
So, we're diving deep into the new lump sum allowance. By the time we're done here, you're going to know exactly how this new £268,000 cap on tax-free cash works, why the old system was scrapped, and most importantly, what you need to do about it right now to protect your wealth. So, here's our game plan. We'll kick off with the new rules, break down that tax-free cap, and what it means for your family's future. Then, we'll walk through a real-life example, show you how to get the most out of your payout, and wrap up with a clear action plan. Let's get started.
Right then, Section 1, the new pension rules. Since April 6, 2024, the whole landscape for pension tax has been redrawn. Really getting your head around this shift is the first step to making sure your retirement strategy is still up to the job.
Okay, first things first, let's bust a huge myth we're hearing from business owners all the time. Yes, the old lifetime allowance, the LTA, is gone, but a lot of people think this means all the limits are off, that their pension pot is now some kind of tax-free playground. Believe me, that is a dangerously expensive assumption to make.
So, the real question you should be asking yourself is, what's replaced it? Because the government didn't just get rid of the rules, they swapped them for something a bit more subtle, and in some ways, a whole lot more complex. The new lump sum allowances.
And this sums up the change perfectly. See, in the old world, the LTA was a cap on your total pension value. If your pot got too big, you got hit with a tax charge. In this new world, there's actually no limit on how much your pot can grow. Instead, the limit is on how much cash you can pull out tax-free. It's a really critical shift from capping how much you can save to capping how much you can withdraw tax-free.
So, with that in mind, let's get into the nitty-gritty. We're going to focus on the first and, for most people, the most important of these new caps for your retirement planning, the lump sum allowance, or LSA.
Right, here is the magic number you need to burn into your memory. £268,275. The best way to think about this is as your personal lifetime budget for tax-free cash from your pensions. Every time you take a tax-free lump sum, you're spending a bit of this budget. And once it's gone, well, it's gone.
So the crucial point here is this. The LSA is the absolute maximum you can take out tax-free across all your pensions. It's not per pot, it's a total for you. Anything you try to take as a lump sum over this limit just gets added to your income for that year and gets taxed at your usual rate. Could be 20, 40, or even 45%. Ouch.
So what actually eats into this budget? Well, it's not just one thing. The one you probably know is the standard 25% tax-free cash you take when you start your pension. That's officially called a Pension Commencement Lump Sum, or PCLS. But your budget is also used up by the tax-free bits of other flexible withdrawals and some other less common lump sums. The big takeaway here is you've got to track all of it.
But you know, this isn't just about your retirement. It's also about what you leave behind for your loved ones. And that brings us to Section 3, and the second key allowance you need to know about, the Lump Sum and Death Benefit Allowance, or LSDBA.
The LSDBA is a much bigger allowance, set at that old LTA level of just over £1.07 million. This one covers all the tax-free cash you take in your lifetime, just like the LSA. But, and this is key, it also includes any tax-free lump sums that are paid out to your family if you pass away before you're 75. And here is the connection that every single business owner needs to understand. These two allowances are joined at the hip. Every pound of tax-free cash you take for yourself from your LSA directly reduces the amount of tax-free cash your family can receive from your LSDBA. It's a straight trade-off between your lifestyle now and their inheritance later.
Okay, enough of the theory. Let's make this real. In this next section, we'll run through a practical case study to show you how these new rules can create an unexpected and pretty expensive trap, even for people who've done everything right.
So, let's meet our director. They run a successful SME, they've been saving diligently into their pension for decades, and they've already started taking some of their benefits. A really common scenario for our clients.
All right, here are the numbers.
Before the rules changed in 2024, our director had used up 40% of the old lifetime allowance. They've now got another pot of £700,000 ready to go. So you'd think they could just take 25% of that, £175,000, as their next tax-free lump sum. Simple, right?
Well, not quite. And this is the trap. Under the new rules, HMRC's default calculation just assumes that 25% of whatever you used of the old LTA was taken as tax-free cash. So for our director, it assumes they've already taken £107,310 tax-free. That amount gets knocked off their total LSA, leaving them with just over £160,000. So the shocking result? When they go to take their £175,000, over $14,000 of it is suddenly taxed as income. What a nasty surprise.
But, and it's a big but, there is a solution. In Section 5, we're going to show you how a bit of proactive planning can help you sidestep this trap entirely and really optimize your pension payout. This is where professional advice really pays for itself.
See, that default calculation makes one huge assumption. But what if it's wrong? What if, like a lot of people, especially those with older company pensions, you actually took less than the maximum 25% tax-free cash in the past?
This is where something called a Transitional Tax-Free Amount Certificate, or a TTFAC, comes into play. It's basically a formal document you can get from your pension scheme to correct the record. It replaces HMRC's guess with the actual provable amount of tax-free cash you took, and that can potentially reclaim a huge chunk of your allowance.
And this table just lays it all out in black and white. Let's say our director can prove they only took £75,000 tax-free before. With a TTFAC, their used LSA drops to that actual amount. And look at that. Their available tax-free cash jumps to over £193,000, more than enough to take their planned £175,000 completely tax-free. In this case, it's unlocked an extra £32,310 of tax-free money. Now that is a game changer.
And here is our most vital piece of professional advice today. You must apply for this certificate before you touch your pension for the first time after April 6, 2024. I can't stress this enough. The moment you take that first payment, the default calculation is locked in. Forever. The decision is irreversible, and you need complete evidence of everything you've taken before. The clock is ticking on this.
Okay, that brings us to our final section. A clear, actionable plan to help you navigate all of this and make sure your financial future is secure.
Here's what you need to do. 1. Review. Go back and audit every single pension benefit you've taken before April 2024. 2. Evidence. You need to gather the paperwork, the old statements, the letters, anything that proves the exact tax-free amounts. 3. Assess. Figure out if applying for a TTFAC is actually going to benefit you. 4. Strategize. Plan your future withdrawals with both your own income and your legacy in mind. And 5, and honestly, this is the most important step, consult. Talk to a professional tax advisor. These rules are tricky, and a mistake could be really expensive.
Now, just a quick note. This explainer is for informational purposes only. It's not formal financial advice. Everyone's situation is unique, and as we all know, tax laws can and do change.
So, the takeaway is this. Getting rid of the lifetime allowance wasn't a simplification. It was a fundamental shift that really demands your attention. Don't get caught in that default trap. It's time to take control of your pension strategy. Get in touch with us here at ProTax Accountant to review your position and make sure your retirement plan is fully optimized for this new world. And for more expert insights for UK business owners, make sure you subscribe to our channel. Thanks so much for watching.